Okay, so tell us where we are in the cycle. Last time you were with us, you said it's coming, basically the repricing is not quite done yet. Where are we on the repricing?
In terms of the repricing, it's about 20% on average across the sectors. And that can range from something like manufactured housing that has had really almost zero declines to office that's closer to 35%. So at PGIM Real Estate, we've projected that by the end of the day, sort of peak to trough, it'll be probably on average 22%. So if we're at 20, we're very close. And so we're feeling a lot better. And, you know, from my perspective, a lot of the doom and gloom about the sector has been somewhat overblown.
So I'm sure you're not a market timer. At the same time, you have to have some sense of that cycle, because if you wait too long, the prices can come back up and you lose some opportunities. Do you have any sense of where it really makes sense you need to get back in?
We're advising our investors that June 30th could likely be a very attractive entry point. And at that point, it's possible that maybe you're a quarter early, maybe there's one more quarter of some value declines. But in this case, we really believe that it's better to be a quarter early than a quarter late. There's broad consensus that there's a lot of capital on the sidelines that is going to come in as soon as they feel like the values have bottomed.
We've heard some talk about a wall of maturities. Is there a wall of maturities coming where people are going to all have to refinance at the same time and have problems?
There is a wall of maturities. There's lots of different numbers out there. One of the more popular numbers is $2.2 trillion of maturities that are coming somewhere between 2004 and 2007. I've been at this for a little over 35 years. In that time, there have been at least 3 other times where a wall of maturities was about to crush us any minute, and it never came to fruition. And what happens in real life is very different than what a chart on a piece of paper is going to tell you. The fact is that borrowers get ahead of their maturities. Loans are extended, loans are restructured, and loans are repaid. And even in a very capital-constrained environment like we're in right now, loans are being repaid every day.
We tend, in the media, we tend to talk about real estate or commercial real estate. But how specific is it? Even within the office space, some offices presumably are created more equal than others.
There's a lot of divergence in the office space, and it's a really good point, because in reality, especially if you look at the public markets are pricing office, the sector broadly, as if it's a very homogenous sector. And it's not a homogenous sector. It's never been a homogenous sector. But right now, it's the least homogenous that it's ever been. And there are, you know, as many people have talked about, winners and losers in the office sector. And what do the winners look like? The winners generally have some level of green certification. We've seen recently that there's about a 50% difference in the availability rate in office buildings that have some level of green certification, are close to transit. There's a huge difference in how those assets are faring.
At what point does it make sense to invest in an existing office building to bring it upscale when it comes to things like green and office air quality?
That's actually a very strong strategy right now, and in particular in Europe. In Europe, you know, one of the investment theses that we believe very strongly in is in taking existing office stock in some place like Paris and investing to make it, you know, enable it to have the ESG certifications that both tenants and then ultimately investors are looking for.
So we've been talking about offices. What about multifamily dwellings? I mean, where does that stand? Because we've seen some sort of a suppression in the building of new homes.
Yes, for sure. We're seeing a suppression in supply of new homes, but also in sales of existing homes, which is really being driven by interest rates. So we have a lot of conviction around the living sectors broadly, and in particular in this idea of people renting for longer, more people renting for longer. So there's a lot of growth in the population cohort that tends to rent single-family dwellings. And single-family dwellings from an ownership perspective are less and less attainable by people because of a lot of trends that we've talked about. This longer, higher for longer interest rate environment, the fact that there's not a lot of supply of new homes. All of that leads to less and less people being able to afford to actually buy a single-family home, and therefore they're going to rent one. So historically, the pricing difference, the cost between renting a single-family home and owning a single-family home has been somewhere in the 30 to 35% range. Now, because of interest rates and the cost of for-sale housing, it's closer to 70%. So it's really like an historic delta, and it's going to take a while. It will come down, but we think it's actually going to be years before it even gets close to 40%.
One other topic, and we touched on this last time as well, and that's data centers. We hear about data centers an awful lot. Where is that market right now? Is it close to saturation?
I wouldn't say it's close to saturation. From a demand perspective, there's still a tremendous amount of demand. There's a very long lead time in terms of, bringing a data center online.
How long?
If you will. It can be years, because first you have to get the power, and then you start building. So it really can be, and there are certain markets in the U.S. where it's years to get the power that you need. And if you think about, the investment theses and the demand side, you think about the ubiquity of cloud computing, and you think about the continued adoption of AI. We see a long-term demand fundamental here, and it's very much of a landlord's market right now, and the rental increases have been double-digit and are expected to continue.